It begins with a subtle warning from economists. Inflation is rising, while economic growth stagnates. At first, the warnings are treated as precautionary, but as months turn into years, the United States enters a period of prolonged stagflation, simultaneous high inflation, and stagnant economic growth. Unemployment rises, consumer prices soar, and corporate earnings stagnate. The phenomenon shocks investors, policymakers, and citizens alike as it challenges decades of economic theory, policy tools, and market expectations. The immediate effect is felt in household finances. Inflation erodes purchasing power, causing essential goods such as food, energy, and healthcare to become increasingly expensive. Stagnant wages compound the pressure, forcing households to reduce discretionary spending, delay major purchases, and dip into savings. Stock markets respond quickly. Consumer-driven sectors like retail, travel, and leisure see early declines in revenue expectations, translating into downward pressure on stock valuations. Financial institutions face complex challenges. Banks and credit unions recalibrate lending risk models as consumers and businesses struggle with rising costs and constrained income. Defaults on personal loans, mortgages, and credit cards rise modestly but steadily. Stock prices for financial services firms reflect heightened credit risk, while lending activity slows due to uncertainty and higher perceived risk premiums. Corporate strategy undergoes rapid transformation. Companies across industries adopt cost-cutting measures, delay expansion plans, and restructure operations to maintain profitability amid stagnant revenue growth. Firms dependent on consumer spending pivot toward essential goods and services, while others explore automation and efficiency improvements. Stock markets reflect sectoral divergence. Essentials and utilities gain relative strength, while discretionary and luxury sectors suffer. Employment dynamics shift. Unemployment rises, particularly in manufacturing, service, and consumer-dependent industries. Many workers face stagnant wages, reduced hours, or layoffs, creating widespread economic anxiety. At the same time, sectors such as healthcare, energy, and essential services see stable employment due to consistent demand. Stock valuations for companies in these resilient sectors reflect investor preference for stability during prolonged stagflation. The Federal Reserve and policymakers struggle to respond. Traditional tools, lowering interest rates to stimulate growth or raising rates to control inflation, offer limited relief. Persistent price increases coexist with low economic growth, creating a policy conundrum. Stock markets fluctuate sharply as investors try to anticipate central bank decisions, fiscal interventions, or market stabilizers. Consumer behavior adjusts in the medium term. Households prioritize necessities over discretionary spending, seek alternative revenue streams, and increase savings when possible. Demand for affordable goods and services rises, while luxury and non-essential markets contract. Stock prices for consumer staples, discount retailers, and essential service providers rise relative to struggling sectors. Corporate debt markets face pressure. Borrowing costs rise as lenders perceive higher risk in an environment of slow growth and high inflation. Companies with significant leverage must navigate rising interest expenses, leading to deferred investment or strategic restructuring. Stock valuations for both corporate borrowers and lending institutions reflect this complex environment. Inflation affects savings and investment behavior. Fixed income products such as bonds lose real value, prompting investors to seek assets that provide inflation protection, including real estate, commodities, and inflation-linked securities. Stock markets for companies producing or supporting these assets, such as real estate investment trusts, commodity firms, and financial advisors, benefit from adjusted investor preferences. Global trade patterns adjust to prolonged U.S. stagflation. Exporters face competitive challenges as domestic costs rise and currency values fluctuate. Import-heavy industries experience higher input costs, creating pricing pressures that ripple across corporate supply chains. Stock markets for multinational corporations reflect both revenue pressure abroad and input cost challenges at home. Energy and commodity sectors face unique dynamics. Rising energy costs drive higher revenues for domestic energy producers, while simultaneously straining corporate and household budgets. Stock valuations for oil, gas, and renewable energy firms fluctuate as markets attempt to balance supply, demand, and geopolitical risk in a high inflation environment. Corporate mergers, acquisitions, and strategic partnerships adapt to the new reality. Companies seek consolidation opportunities, cost synergies, and diversification to navigate uncertain revenue streams. Stock markets react to M&A announcements, with successful strategic positioning rewarded, while poorly timed expansions face investor skepticism. Government programs and fiscal policy face heightened scrutiny. Social safety nets, unemployment benefits, and public assistance programs see increased demand amid prolonged economic stagnation. Stock valuations for companies providing government services, healthcare, and social infrastructure reflect potential revenue from expanded government engagement. Consumer debt behavior evolves. With rising prices and stagnant income, households borrow to maintain living standards. Credit utilization rises, delinquencies increase, and lending practices tighten. Stock markets for banks, credit providers, and debt management services reflect increased risk and demand for financial solutions. Corporate earnings projections stagnate. Firms struggle to grow revenue in a climate of persistent cost pressures and reduced consumer spending power. Stock valuations reflect tempered expectations, with investors favoring sectors with predictable cash flows and inflation-resistant pricing. Technology and innovation sectors respond with both challenge and opportunity. High inflation increases costs of research and development, while stagnant growth limits new capital investment. Yet, automation, AI, and efficiency technologies gain traction as firms seek to reduce labor costs and optimize operations. Stock markets for technology providers reflect both risk from constrained budgets and opportunity in operational innovation. Real estate markets experience mixed effects. Residential housing demand softens due to inflationary pressures and reduced disposable income, while commercial properties aligned with essential services and logistics maintain value. Stock valuations for REITs and real estate companies reflect regional and sector-specific dynamics. Corporate governance and risk management become central to investor evaluation. Firms demonstrating adaptability, prudent financial planning, and resilience to cost pressures outperform peers, influencing stock performance during the prolonged stagflation period. Consumer and investor psychology shapes market behavior. Widespread fear of stagnation and inflation drives risk aversion, favoring essential goods, defensive stocks, and inflation-protected investments. Stock markets reflect this shift, with traditional growth sectors underperforming relative to stability-focused industries. Supply chains face persistent disruption. Rising costs, fluctuating demand, and delayed investment create inefficiencies, forcing companies to innovate logistics and sourcing strategies. Stock valuations for logistics, industrial supply, and operational technology providers respond to both opportunity and risk. Global investors monitor U.S. economic stability closely. Capital allocation shifts toward inflation-resistant assets, safe haven markets, and international diversification. Stock markets of U.S. multinational corporations experience fluctuations as foreign investors adjust exposure to domestic economic uncertainty. Financial institutions adapt risk management frameworks. Lending strategies, portfolio allocations, and credit assessments are revised to account for prolonged inflationary pressure and economic stagnation. Stock valuations for banks, asset managers, and insurance providers reflect increased demand for hedging solutions and financial resilience. Labor market dynamics create social pressure. Wage stagnation, rising living costs, and delayed retirement patterns increase public dissatisfaction. Stock markets for consumer-facing sectors reflect ongoing volatility as purchasing patterns adjust to constrained household budgets. Energy, transportation, and logistics sectors navigate fluctuating costs. Fuel prices, shipping expenses, and operational overhead rise amid inflation, while demand growth stagnates. Stock valuations for energy and transport firms reflect the balance between revenue potential and cost pressures. Corporate innovation focuses on cost efficiency and operational resilience. Automation, lean management, and strategic procurement gain prominence, with stock markets reflecting both risk and reward of technological adaptation. Government debt markets respond to inflation and stagnation. Treasury yields fluctuate as investor confidence is tested, while the Federal Reserve struggles to balance interest rates and inflation expectations. Stock markets respond to bond market volatility with cross-sector impact on equity valuations. Consumer spending patterns evolve toward essentials, discount retail, and services offering perceived value. Luxury markets and discretionary sectors underperform, with stock prices reflecting changing demand dynamics. Corporate mergers and acquisitions accelerate in sectors resilient to stagflation. Companies seek to consolidate, diversify, and optimize operations, with stock valuations rewarding strategic foresight and efficiency gains. Education, healthcare, and essential service sectors experience sustained demand. Firms providing critical services adapt pricing, service delivery, and operational efficiency to navigate inflation, reflecting stable or improving stock performance. Corporate debt and capital markets recalibrate. Companies refinance or restructure debt to manage rising interest rates and cash flow constraints. Stock prices for borrowers and lenders reflect market expectations of debt servicing capacity under prolonged stagflation. Global trade exposure affects corporate revenue. Export competitiveness declines due to high domestic costs, while import-heavy sectors face rising prices. Stock markets for multinational firms reflect these macroeconomic pressures and strategic adaptation efforts. Labor markets undergo long-term adjustment. Stagnant wages, high inflation, and employment uncertainty influence worker mobility, career planning, and sectoral employment patterns. Stock markets reflect corporate exposure to workforce dynamics and productivity considerations. Corporate governance, transparency, and financial discipline become critical. Firms demonstrating operational resilience, fiscal prudence, and adaptability outperform peers reflected in stock market performance. Financial planning and wealth management sectors see heightened demand. Consumers seek advice for inflation protection, retirement planning, and asset allocation, driving stock valuations for advisory firms, investment managers, and financial services providers. Consumer behavior gradually adapts. Households prioritize savings, essentials, and income diversification. Spending shifts from discretionary to necessary sectors, influencing stock valuations across retail, consumer goods, and essential service industries. Policy intervention remains uncertain. Debates over fiscal stimulus, targeted relief, and monetary tools dominate political discourse. Stock markets react to perceived likelihood of effective intervention or continued stagnation. Corporate strategy increasingly emphasizes diversification, risk management, and efficiency. Firms realign portfolios, optimize operations, and target resilient sectors. Stock markets reward firms demonstrating long-term adaptability and operational foresight. Infrastructure, energy, and technology sectors benefit selectively. Investments in automation, renewable energy, and logistics optimization provide opportunity for revenue stability, reflected in stock valuations. Global economic interconnections amplify impacts. U.S. stagflation influences foreign markets, currency values, commodity prices, and international investment flows. Stock markets of multinational and export-oriented firms reflect these complex global dynamics. Financial markets experience a cycle of volatility and adaptation. Initial panic subsides as households, corporations, and investors adjust strategies. Stock indices reflect differentiated sector performance, resilience, and risk-adjusted growth expectations. Consumer credit and debt behavior remain critical. Households prioritize debt management, savings, and essential spending, influencing stock valuations for financial services, lending institutions, and consumer credit markets. Corporate innovation targets efficiency, cost reduction, and revenue stability. Technological adoption accelerates in response to rising operational costs, supporting long-term competitiveness. Stock markets reward adaptive and innovative firms. Social and political pressures intensify. Public discourse emphasizes income inequality, policy reform, and economic stability. Stock markets respond to both uncertainty and opportunities created by potential regulatory or fiscal interventions. Global investor strategies evolve. Allocation shifts toward inflation-resistant assets, essential goods, and sectors demonstrating predictable cash flow. Stock markets adjust as foreign and domestic investors recalibrate exposure. The scenario illustrates how prolonged stagflation would reshape the U.S. economy. From consumer behavior and corporate strategy to financial markets and global trade, the impacts are pervasive, multifaceted, and enduring. Stock markets reflect immediate volatility, sector-specific opportunity, and long-term adaptation to a fundamentally altered economic environment. Ultimately, a decade of U.S. stagflation would redefine investment strategy, corporate planning, household behavior, and government policy. While the short-term impacts are severe, adaptation, innovation, and fiscal strategy could stabilize markets, offering resilience and long-term opportunities amid persistent economic challenges.